How do you see today's market day shaping up? As we just mentioned, the Santa Claus rally didn't happen. What's your WEX word of the day?
Well, my WEX word of the day is reversion, meaning mean reversion into laggards. And that's what we actually have been seeing over the last couple of weeks, actually. Since the bottom of October, the equal weight S&P 500 actually has outperformed the market cap weight of the S&P 500 by 200 basis points. What does that mean? It just means that we're starting to see a broadening out in the market. And it's actually continued into this year. In the last couple of days, you've seen a sell-off in technology and comm services, and you've seen some of the lagging sectors, financials and healthcare, utilities, all doing a little bit better. So I think you're going to continue to see that, Frank, because I think if we do have a soft landing, earnings are going to come in pretty good for a lot of different sectors and a lot of different companies, not just the Mag 7.
So I know you're watching the broader economy. It kind of shapes your view of the markets as well. So yesterday, the Atlanta Fed came out with its real-time GDP number. They actually raised what they expected for Q4 GDP from 2% to 2.4%. And they said that's, 2.5%. And they said that's largely due to continued consumer spending and business confidence. What does that make you think about the markets as you see this broadening?
Yeah, I mean, there's a lot of talk about soft landing, but honestly, the data supports soft landing for now, right? You just said 2.5% GDP, consumers doing better. Manufacturing, parts of it are seeing a renaissance due to a lot of the infrastructure bills that have been passed. Inflation is coming down. Yesterday's JOLTS number, the number was in line, but more importantly, the quits number came down, and that's a leading indicator for wages. So wages are coming down. That's what the Fed wants to see. And layoffs, though, at the same time, are lower. So that is the recipe for soft landing. And I think that, again, is going to translate into better earnings ahead. And, again, kind of a broadening out into other sectors because they are still very cheap and kind of still unloved.
Let's talk about one of the laggards last year, healthcare. That's also where you have some picks for us. Why are you feeling bullish on healthcare right now?
So, yeah, well, it's definitely a laggard group from last year for sure, but they have great product innovation, strong free cash flow. There was over $370 billion of M&A that has taken place over the last year. That's really gone unnoticed, in my opinion, and the valuations are pretty attractive.
And you have some picks for us as well.
Yeah. So GE Healthcare is one I have owned, and I like it very much for this year. Basically, it's a spin out from GE, which, by the way, I also like GE. But GE Healthcare, it's a spin out, and I like spin outs because that means the management teams can be focused on execution and growth, and that's what they have been doing. And in 2024, I expect hospital CapEx to be up 2.5%. Focused on imaging and ultrasound, and that's where they have the dominant market share. So mid-single digit organic growth and margin expansion means about 13% earnings growth for the year.